A man checks his phone at 7:03 a.m. He hasn't gone to work yet. He's still in bed. And according to the app, he just made $127 while he was asleep. Dividends, rental income, maybe a slice of some online business he barely touches. It feels like magic. Money from nowhere. But here's the uncomfortable truth no one puts in the thumbnail. Most passive income isn't passive, and it definitely isn't free. It's just risk, wearing a nicer outfit. Right now, passive income is one of the most powerful ideas on the internet. Scroll through finance content, and you'll see the same promise repeated in different fonts. Escape the 9-to-5, build assets, make your money work for you, replace your salary with cash flow. In a world where inflation eats paychecks and job security feels thinner every year, that promise hits hard. Who wouldn't want income that doesn't depend on a boss? But to understand why most cash flow hides more risk than people realize, we have to slow down and ask a simple question. Where does that money actually come from? Let's start with dividends. When a company pays you a dividend, it feels like a reward. You own shares, the company makes profits, they send you cash. Clean, simple. Except the dividend doesn't appear from thin air. It comes from business earnings. And those earnings depend on sales, margins, debt costs, and the broader economy. If profits drop, dividends get cut. It happens more often than the highlight reel suggest. Look at 2020. When the pandemic hit, dozens of large companies slashed or suspended dividends almost overnight. Airlines, retailers, energy firms. Cash flow didn't flow, it evaporated. What looked passive was always conditional. Now take rental income. Owning property is often sold as the ultimate passive play. Buy a house, rent it out, collect checks, build equity. But rental income is leveraged income. Most property investors don't buy with cash. They use mortgages. That means their cash flow depends on interest rates, occupancy, maintenance costs, local laws, and property values. When rates rise, mortgage payments jump. When tenants stop paying, the landlord still owes the bank. When a roof leaks, it doesn't wait for your spreadsheet to update. In 2022 and 2023, as interest rates climbed sharply in many countries, investors who bought at low fixed returns suddenly faced higher refinancing costs. Some positive cash flow deals turned negative. The income didn't disappear, the margin did. And that margin was the only thing protecting them from stress. Then there's the new frontier: online businesses, digital assets, automated stores, content monetization. Build it once, earn forever. That's the pitch. But digital income is usually platform-dependent income. If your revenue depends on an algorithm, an ad network, or a single payment processor, your asset lives inside someone else's system. Policies change, traffic shifts, competition floods in. What feels automated is often fragile. The deeper pattern here is simple but rarely discussed. Passive income compresses effort but expands exposure. When you work a job, your income depends mostly on one thing: your continued labor. That has its own risks, of course. Layoffs happen, burnout is real. But when you switch to passive income, you trade labor risk for capital risk. Instead of depending on your time, you depend on assets, and assets fluctuate. Stocks fall, property markets cool, tenants default, platforms shut down accounts, interest rates move, regulations change. Passive income doesn't eliminate uncertainty, it shifts it. There's another hidden mechanic most people ignore: sequence risk. If you rely on cash flow from investments to fund your life, timing suddenly matters a lot. Imagine you build a portfolio designed to yield 5% annually. On average, it works. Over decades, the numbers look fine, but averages don't pay your bills. Monthly cash does. If markets drop 30% early in your withdrawal phase and you're forced to sell assets to maintain income, you lock in losses. The portfolio shrinks. Future income shrinks with it. The passive machine becomes sensitive to timing shocks, and timing is not something you control.
Even high-yield strategies come with trade-offs. When you see unusually high returns, 10%, 12%, 15% cash flow, that yield isn't a gift. It's a signal. Higher yield often means higher perceived risk. Distressed companies pay more to attract capital. Riskier borrowers offer higher interest. Speculative real estate markets promise bigger rent spreads. The income looks generous because the uncertainty is larger. This is where the myth becomes dangerous. Online narratives often frame passive income as a clean upgrade. Step 1, quit job. Step 2, buy assets. Step 3, live off cash flow. But the reality is messier. Most people build passive income on top of active income first. They use salaries to accumulate capital. They diversify, they reinvest, they accept volatility. And even then, the passive stream usually needs monitoring, adjusting, and sometimes repairing. The irony is subtle. True passivity often requires significant upfront effort, discipline, and a tolerance for boredom. It's less about flashy deals and more about risk management. Diversification, cash reserves, conservative assumptions, accepting lower yields in exchange for resilience. That doesn't sell well on social media. Build a diversified, low volatility income stream with moderate expectations doesn't trend, but it survives downturns. There's one more layer to this: psychological risk. When income feels passive, it can feel permanent. And when it feels permanent, people start building fixed lifestyles around it. They upgrade houses, increase spending, take on new obligations. But if that income dips, even temporarily, the stress multiplies, because now the asset volatility hits your daily life. What was once extra income becomes essential income, and essential income cannot be volatile without consequences. None of this means passive income is fake. It's not. Owning productive assets is one of the most powerful wealth-building tools ever created. Equity ownership built fortunes. Rental portfolios funded retirements. Bonds financed stability for generations. But those outcomes came with patience, diversification, and an acceptance of risk, not the denial of it. Passive income is not a cheat code. It's a financial structure, and every structure has load-bearing walls. If you remove the understanding of risk from the conversation, the structure looks elegant, effortless, smooth. When you add risk back in, you see the beams, the stress points, the parts that can crack under pressure. So the next time you see someone celebrating money earned while sleeping, pause for a second. Ask the quiet question behind the screenshot. What risk is paying for that return? Because somewhere, something is fluctuating. A stock price, a tenant stability, an interest rate, a platform's algorithm, a borrower's creditworthiness. Cash flow is rarely free. It's compensation for uncertainty. And the real skill isn't chasing the highest stream. It's deciding which risks you're willing to live with. So here's the question that lingers. If your income doesn't depend on your time anymore, do you truly feel safer? Or have you just made your financial life dependent on forces you can't see and can't control?